Good evening, everybody. How are you guys? Who all are there in the lecture? Can you tell me? Okay. Hi, Pooja. Hi, Pooja. Should we start, guys? Should we start? What do you say? Should we start quickly? Okay, because any which will have 1.5 hours or so, and I think we should be able to finish a good portion in 1.5 hours. That shouldn't be a problem. Yeah. So the topic that we have to start is hedging of a stock portfolio using futures. Okay. So what happens if you have a portfolio? If you are okay. So if you are suppose a fund manager and you are holding a portfolio, then what would you be afraid of? I would be afraid of stock value going down. Correct. So if suppose you are afraid of stock value going down, so naturally you would want to build up a position in a parallel asset which saves that fall. Okay, that way. So maybe like how to think. Suppose I am already long on portfolio. Okay, and if the market goes up, there is no problem at all because I would like to have that kind of situation. But then if the market goes down, then I would lose a value on portfolio, right? So why not create a parallel position wherein if the market goes down, then I earn money. So that is what you are studying here. The hedging of a stock portfolio using futures. Okay. So I've given a question here, guys. I think I will be able to explain you with the help of the example better. Consider a fund manager, this one, managing a corpus of 250 CR comprised as follows: equity 150 CR and beta with a beta of 3, debt 80 crore with a beta of 0.8, cash and cash equivalents, okay, 20 crore and beta 0. Nifty futures trade at a multiple of 50, okay. So now, how many Nifty futures contracts should be bought or sold for a complete hedging? This word is very important here. Wait a minute. This word is very important. I tell you why it is important, not immediately, but yeah, after some time. How many Nifty futures should be bought or sold to achieve a target beta of 0.5? Okay, and along with this, I have added one question from my side, prove the same. Here also you'll see prove the same. Here the word goes complete hedging. Okay, and here the word goes 0.5. There's a difference between the two. Okay, so now there's an equation that I have set for computing this answer. So number, you will understand everything, don't have to worry at all. So number of lots, VP, BT minus BP divided by BF into lot into futures price. What is this exactly? So basically BT stands for beta of the target beta basically. BP stands for beta of the portfolio. They have not given beta of the portfolio. You can calculate this. Okay. So basically what does this mean? One by one. The current beta of my portfolio is 2.056. I don't like this because if the market goes down by 1%, my portfolio will lose value by 2.056%. But also if the market goes up by 1%, my portfolio will gain by 2.056%. Gaining is not a problem. The problem is that I can't have such a huge amount of risk with the portfolio actually. I want to reduce that. So reduce that, how much? You can say, ma'am, I want to reduce all of it. That is complete hedge. So you know what will happen? If the market goes down, okay, by any percentage, so your portfolio will go down, you will lose value, assume to the extent of 5 crore. You will lose value on the portfolio, okay, but you will gain on the futures because you go short on futures. If you are long on portfolio, you will go short on futures. You can ask me, why can't we go long on futures? You can't go long on futures because you are already long on portfolio. If you go long on futures also, then what will happen? If the market goes up, gain, gain, double gain. If the market goes down, loss, loss, double loss. I am wanting to reduce my loss, okay. So naturally you will create a position which is exactly opposite to your cash position, okay. So if you are long on portfolio, you will go short on futures, but to what extent? If you do a complete hedging, you know what will happen? If the market goes down by certain percentage, suppose you lose value worth 5 CR on the portfolio, you will gain exactly on the futures by 5 CR. That means you are completely offset. Correct. But this is not a problem. This I like, because when the market went down, I do not have to face any loss. There is a problem when the market goes up. Okay, why? Because if the market goes up by certain percentage and if you gain 5 CR on the portfolio, complete hedge means BT equal to 0, Harsha. Complete hedge means BT equal to 0. Okay, now the point is that again, when the market goes up and if the portfolio gains by 5 CR, you know what will happen? Because of the opposite position, the futures will reflect a loss of 5 CR. Okay, so what is happening? Whether the market is going down or up, you are intact with your portfolio principal value, no change at all, neither less nor more. If this keeps on happening for one more year, why have you invested money at all? You can ask the fund manager, what did you do with my money? You say it did not go down. See, I protected your value. But you will also say that, yeah, you did not allow it to go down, but then I wanted some return also, and hence complete hedge is not a very wise strategy to do. So you leave some scope, and that is 0.5. Suppose that can be decided 0.5 or anything below 2.056 is like you want to reduce it. Okay, so if you reduce it to 0.5, then what will happen? If the market goes down by 1%, you will lose by only 0.5%. If the market goes up by 1%, you can gain only by 0.5%. You leave some scope for growing also. So if you leave some scope, both ways you'll have to leave. If you reduce that part completely, both ways you reduce. That is the logic here. So using this basically guys, 250 crore, when they say complete hedge, it has to be 0 by default. Look at this. And you complete, number of lots are given to you. This is a proof part that I show you. Suppose Nifty go down by 10%. What happens? In the cash market, the portfolio value loss will be 250 crore into 2.056 into 10%. Why? If the beta means if the market goes down by 1, I go by 2.056. Okay. Okay, so 51.4 crore is your loss. Here guys, what happens? You went short on futures at a price of 5,000. Okay, now here the closing price will be 10% below. And when you square off, what is this? 5,000 minus 4,500 into number of lots, and every lot has got 50 shares of Nifty. You get exactly, this profit is exactly 51.4 like the loss. So if the Nifty goes down by 10%, you are completely offset. Same will happen when the Nifty goes up and you won't like it. And hence complete hedge is something you would want to have when the market is falling down like an X and you just can't control. You just don't bother about returns. You want to protect your principal value. That is the logic. Achha, futures price, that is a mistake in the question. Futures price, okay, futures price 5,000 is a mistake in the question. They will definitely give you, and if they do not give you, they will give you data for cost of carry model to calculate it. It will never happen that they are not giving you the data to calculate, nor are they giving you the value. It will not happen, because if they do that, you will not be able to calculate the answer. It's not possible. There's a typing error in the question. Now, suppose market goes up by 3%. What will happen? Your portfolio will gain by 2.056 into 3%. That gives you 15.42 CR. And opening price is 5,000 and closing price is 5,000 plus 3%. Okay, because the market went up, that's why it is a plus sign. So what happens here? You gain because market went up and you are long, but here you are incurring a loss, but this loss is lesser than the profit. So take a net. So 15.42 gain minus 11.67, net gain is 3.75. What is the percentage of 3.75 into 50? 1.5%. So what is the beta? Percentage change in the portfolio, percentage change in the market. The portfolio changed by 1.5% when the market went up by 3%. So the beta is 0.5. That is what you get. Guys, all of you understood? Could you understand this, all of you? Okay, question number 11. BSc, this question is again very interesting question, guys. So here, BSc 5,000, value of the portfolio 10,10,000, risk-free rate, all of you are fine, guys. Okay. Value of the portfolio, this is a very important question from the upcoming exam point of view also. Okay, BSc 5,000, value of the portfolio 10,10,000, okay, risk-free rate of interest is 9% per annum. Dividend yield on index is 6% per annum. Beta of the portfolio is 1.5. Okay. We assume that the futures contract on the BSE index with 4-month maturity is used to hedge the value of the portfolio over the next 3 months. One futures contract is for delivery of 50 times the index. Be careful about some data. They are saying that the BSE index futures are for 4 months. Okay. Maturity is used to hedge the value. Your maturity is 3 months. Harsha is saying that. Thank you so much, Harsha. Thank you so much. Okay. We assume. Okay. So one future. She is writing there ki please everybody respond positively, and because that will encourage ma'am to continue with the lectures. Yeah, because I am sitting here. I know that it is not that kind of people don't know me or something like that, but then since if I take a live lecture, I would want people to be there. What is the point if suppose I make you sit on a stage and if there is nobody, how would you do any acting or dance or something? It is like that. But what I feel is that maximum people have already covered with the help of Hindi lectures, and that is why, and it is very less time to the exam now. That is the logic. So take it's okay. Let me finish this topic, at least derivatives. I don't want to leave this topic in between. Okay. Now, so one futures contract is for delivery. So the main point that should have you should have noted is the futures are available for 4 months and your maturity is 3 months. My question to you is that, like Harsha asked me kind of 2 minutes back, that ma'am, the price of the futures is not given, on what basis do I assume? Then I told her that either they will give you the data of the futures price, okay, or they will give you the data to calculate. So is the sum, this one. They have not given you the futures price, but they are asking you to calculate, because without futures price, you cannot calculate the number of lots, because in the formula, VP BT minus BP by BF into lot size into futures price you would need in order to calculate the lots. I would have made you understand a lot of logics in the formula, but at this point of time, we have too less time to talk all that. It is only that if suppose you get a question, you should be able to do that. Okay. So the one question that I want to ask you is that, if I'm supposed to compute the futures price, what maturity should I calculate? Don't look at the answer. What maturity should I calculate? It should be for 4 months or 3 months. That will tell me how much understanding do you have. Actually, what happened 2 times, nobody does, no? Nobody does. Even once, no, it is tiring, kind of not like I'm saying, oh, I'm the great one, I'm doing, I wouldn't talk like that. I don't talk like that. Like, but it is like, it is very tiring because we have other schedules also, no? We have committed schedules where the batches are on, we have taken fees for that. So the priority becomes that we need to perform there because we have taken fees and it is a scheduled thing. Okay, so this goes for a like this thing kind of, and you get tired. It's a very tiring job, so that is why. Okay, so like that. So if people are there, then even if you are tired, no, what happens, you like, okay, chalo, we are like, kind of out of excitement you are able to manage. But if people are not there, yourself you are very tired and all that, then you say, okay, leave it. Maybe like people are able to manage with the Hindi one. It happens that way. 4 months. That is okay, Daniel. Okay, 4 months. Okay, yes, 4 months. Because suppose you want to start from like what place should I take? Chennai. Okay, because either South India batch, Chennai. Okay, suppose a train starts from Chennai and comes to Mumbai. Okay, I don't know the 2 stations in between, but you tell me if you like take the train in Chennai and you want to like get down somewhere in between. Okay, will the train stop there only? No, train will go from Chennai to Mumbai. Okay, you can like take the train from anywhere and get down anywhere. If you want to customize, you have to take a taxi that way. So this futures will be standard for 4 months only. It will not be for 3 months. Yeah, what you can do, you can enter into 4-month futures and exit at the end of the 3rd month. You are allowed to exit, right? So the price at which you will square off will not be the spot price. It will be 3 month. It will be 1 month futures. Sorry, it will be 1 month futures, because because the futures have not matured yet. So you cannot square off at spot price of BSE. You'll have to square off to 1 month futures, right? Correct. Now here, so the first question is price the futures contract. Okay, so I have done that. Look at this. So S, this is I, and this is DY. We get the answer 5050. Then next one, the next question is the gain on the short futures position if the index turns out to be 4500 in 3 months. You know what are they asking? What is this? They're asking this one. This particular step they are asking. Profit on futures. Can you see what do I need for that? I need a opening price at which I went short on futures, which I have already calculated 50-50. Then I need to compute 1 month futures price, which is not given to you in the sum directly, but they've given you a spot price at the end of the 3rd month. Using that spot price, you can calculate 1 month futures price. So you have to calculate this one. Number of lots we do not have, we need to calculate. Okay, now that you have futures price, you can calculate actually, and this is there. So you are supposed to calculate this value. So you can see how many things you need to have. You need to have you need to have this, kind of the squaring of price and the number of lots in order to calculate this answer. They are asking you to calculate this one. So directly from the whole sum, they are taking a jump. Okay, now here, look at this. We can compute gain on futures with the help of below mentioned equation: sell price minus buy price, number of lots into lot size. Sell price, you already calculated 50-50. You went short on futures because you were long on the portfolio of 10,10,000. Okay, but I need to have a buy, the price at which I will buy the futures back, a squaring of price basically. So I will have to compute the 4500 is given in the sum, that is a spot price at the end of the 3rd month, but you cannot square up at spot because futures have not yet matured. So you compute 1 month futures price, this is given to you, lot size is given, and then you compute number of lots. When you went short in futures, you were standing at t equal to 0, and hence the price of the futures will not be that 4511, it has to be the opening price. Okay, and then you compute, you get the answer. Guys, do you understand all this? Did you understand all this? Are you getting all of you? So sell price, since we are going to use 4-month futures to hedge 3-month exposure, the futures would be sold at 50-50 at t equal to 0 to hedge the portfolio. All of you understood, only Harsha is answering. Any which ways, I am not going to ask Harsha because Harsha is our student only. buy price. At the end of the third month, we would square off 1 month. If you have a doubt, you can ask me. That makes me happier. Yes, Daniel, did you understand? Who all have been able to understand? Please tell me. All of you understood, guys, this one? At the end of the third month, we would square off 1 month futures price, okay, 1 month futures, and that needs to be computed with the, these are the notes, guys. You are not supposed to write this in the paper. So basically they asked you to compute the number of lots or maybe the profit on futures. And for that, you have to have such a good imagination in terms of the flow of the question. Otherwise, you cannot do the sum. And this question is a combination of cost of carry model and portfolio insurance using futures. Two topics combined together actually. Okay. Then the third part, if it comes in the exam, I feel that third part will not be asked in the paper, because this question has been taken from a very old RTP. But this question came in the exam also, but always they have been asking part 1 and part 2. Part 3 they have not been asking, because I really doubt that any student would be able to calculate that if they have not seen the solution. Without that, it is difficult to do. Okay. So what have they done here? As per CAPM, they are saying, what is the question? I didn't read the question. Value of the portfolio using CAPM. Okay, not a problem. So as per CAPM, RE is equal to RF plus RM minus RF into beta. As asked in the sum, we need to compute the value of the portfolio at the end of the 3 month as per CAPM. So in order to compute the value of the portfolio as per CAPM, you need to have a value of RF, RM and beta. Beta is given to you in this question. That is not a problem. RF is also given to you in the sum. But you know what? You are standing at 0 and your maturity is 3 months. But your risk-free rate is for per annum. You need to do appropriate adjustment for that. Number 1. For RM, you know what they have given? Look at this. Look at the data. For RM, they have given you this data. If you see properly, guys, they have given you the opening price 5,000. They have given you the dividend yield, and they have also given you the closing price 4,500 here. There is somewhere written this one. Okay. So using this data, I'll show you how to calculate that. Just give me a second, please. Look at this. Holding period return. Don't you know this formula? D1 plus P1 minus by P0. P minus P0 by P0. So D1 by P0 is your dividend yield, and P1 minus P0 by P0 is your growth component. So I segregated into two parts. D1 by P0 and P1 minus P0 by P0. Did you see that? Now D1 by P0 is dividend yield, which is given in the question already. Okay, but that is for per annum. I need for 3 months, and hence a time adjustment is warranted here. The growth part, the opening value is 5,000. The closing value of the index at the end of the third month is 4,500. You use that data to compute the growth part, that is minus 10%. So 1.5 and minus 10 will make it to minus 8.5%. Then RF, I have never seen a sum wherein we are doing these adjustments to RF and all. This is the only question where I am seeing all these adjustments actually. So you need to take out the value, because if you do not do that adjustment, okay, it will be mathematically not compatible. Why? Because 5,000 and 4,500 are two values which are standing at 0 and end of the third month. And hence the dividend yield data or any other data for that matter, whatever you are using, should be already adjusted for the time factor part actually. Okay. So 3 month RF and then apply in the CAPM model, you get minus 13.875%. How do you interpret that? It says that if the market went down by 8.5%, then our portfolio should go down by 13.875%. Can anybody answer me one question? Suppose the beta of my portfolio was not 1.5, if it was 1, then what should have been the return of my portfolio as per CAPM? All of you, can you please answer me that question? I'm asking, that suppose, why did you get 13.875 when the market went down by 8.5%? You should have also gone down by 8.5% only. Why did you go down more? Because the beta is 1.5. My question is a reverse question. My question to you is that if suppose the beta was not 1.5, if the beta was 1, then what of my portfolio, of course, then what would have been the return of my portfolio on the basis of CAPM model? Please tell me the answer. It's a very intelligent question. Harsha deleted. Tell me, 8.5%. Yeah, 8.5%. If your beta is 1, that means your movement and market's movement will be the same. If beta is 1, suppose what did I say? The market went down by 8.5%. You went down by 13.875. Why? Because your beta is greater than market. Okay, so I said that if the beta of the portfolio was not 1.5, if it was 1, then what should have been the return of the portfolio? 8.5 minus, that's it. You will move as per the market. And even if you don't understand what you could have done, you could have done this equation again. Okay, so 2.25 plus minus 8.5 minus 2.25 into 1. Solve it. So what will happen? Minus 2.25 and plus 2.25 will get cancelled and you will be left out with minus 8.5. Okay. So if your beta is same as market beta is always equal to 1, then your return means my equity return or portfolio return should be equal to the market return only, RM. You can be, you should be knowing all this, guys. This is very important points. Now, the last topic of the futures is hedge ratio. I don't know whether how many of you are good at portfolio. So in portfolio, you calculate one variable that is called beta. What is the formula? Cov xy by variance of x. Here x stands for market. X is market, y is stock. Okay, if I break it further, can I write here rxy sigma y sigma x, that is coefficient of correlation, sigma x into sigma x. If I want to cancel, okay, can I do like this and like this? I am left out with beta is equal to rxy sigma y by sigma x. That means to say coefficient of correlation between stock and market multiplied with deviation SD of stock divided by SD of market, correct? So just look at that. A company is long on 10 MT of copper at 474 per kg and intends to remain so for the ensuing quarter. The standard deviation of the changes of its spot and futures price is 4% and 6% respectively, having coefficient of correlation of 0.75. Okay, what is the hedge ratio? So I tell you something, I show you something rather. I gave you a formula, number of lots VP correct. Now tell me one thing, if I set BT to 0, this will open up. Okay, so this will open up in the sense you will get VP, yeah, this is 0 now. If BT is 0, this whole part will become 0 only. VP into BP and that to minus the whole by BF into lot into futures price. I am saying that why are you doing this? Why are you doing this? Because you know what? There are two things. One is the exposure which you want to hedge. For example, in this question, 10 MT of copper is something you are scared that the price will go down. And then there is an instrument with the help of which you want to hedge that, correct? There are two things actually. One is the exposure where you want to hedge the commodity or the stock that you want to hedge. and the another one is the instrument or the derivative with the help of which you want to hedge that exposure. The problem is that both are not moving one to one. Both are not moving one to one. That is a problem. Okay. So in that scenario, what happens, guys, that if they are not moving one to one, we need to bring both of them into tandem. That means suppose me and Harsha are walking. Okay. So if Harsha takes maybe like 2 steps, or Harsha, my steps are half of Harsha. My steps are half of Harsha, and I want to match her. That means I need to take 2 steps in order to match Harsha. That is what I do not want to give. I'm not saying the example which I gave is a perfect example, but just to have some understanding about the things. Okay. So basically we need to match the movement of both, because they are not moving with the same speed. And that is why when you multiply your exposure, guys, are you able to understand? We multiply this with this so that the number of lots that you take should be able to offset all your loss. That is the logic actually. I don't want to go into the detail. A company is long on 10 MT of copper at rupees 474 per kg and intends to remain so for the ensuing quarter. Okay. The SD of the changes of the spot, okay, and futures prices 4 and 6% respectively, having a coefficient of correlation of 0.75. What is the hedge ratio? So hedge ratio, look at this. Can you see the formula? This formula is same as this formula, this one. So basically you are calculating the beta. Okay, so the beta, so you are long on copper and you are afraid of copper going down and you want to use copper futures, but the behavior of the copper spot and copper futures are not same. One walks 1, other walks 0.5, and hence you will not hedge to the extent of the whole thing because you are not required only, and you will hedge only to the extent of half the value. Look at this, 474 into 10 MT 1000 kgs. This is a long position and you multiply with, that means you need to go short this much worth of futures. If you ask, ma'am, what is this? This is the numerator part of this equation. Had they given us beta of the copper futures, the lot size and the price of the copper futures, I would have divided this value to get the number of lots. Guys, all of you need to reply me whether you're getting this or not. Okay. Okay. So now we are starting with options today. Okay. So basic strategies of options. So we have 4 strategies of options that everybody knows, right? So till now what happened? You studied about forwards, you studied about futures. So in both of them, okay, a person has got rights as well as obligation. For example, if you buy a forward, okay, if you buy a forward, then what happens? That kind of Shweta is saying, hello ma'am, I'm not a student, but a humble request to please take 3 chapters of SFM. You are giving exam, Shweta? Okay, let's start. So options. So basically guys, what happens when we are doing forwards and futures, anybody who feels that I'm like, my speed is not that great, unlike the Hindi batch I took, let me be very, very clear on the fact that this is my 4th lecture during the day. I have woken up at 4:30 AM in the morning. Okay. Okay. So I am trying to do whatever I can with the best of my energy possible. I have woken up at 4:30 a.m. in the morning. I had 6:30 to 9:30 a.m. AFM batch. Then I had CFA level 1 batch. Then I had evening something. Okay. And then this is the fourth thing that I'm doing during the whole day. I have very little energy left. Okay. After the whole lengthy day. So I'm just trying to keep my words. Okay. So if you feel that my energy level is low or I'm going slow, I can't perform maybe better than this. And if you think that you want to go faster, either increase the speed of this lecture or you go for the Hindi batch. You will see a lot of energy out there. Two reasons. Number one, the batches did not start at that point of time because and I was relatively freer. Okay, and I had lot of energy naturally. And number two, their students were a lot, all responding back to back. It encourages the kind of the person who is speaking. Okay, so two reasons are there now, but yeah, so I'm just trying to keep my words and did not want to leave the students in lurch actually, because I started derivatives, I left in between because people were not like, maybe they are managing Hindi batch and everything, correct? So you have to bear with that. Now the Hindi people who are wanting to watch faster, and if you understand Hindi, go for the Hindi batch. I have taken just a week before only, hardly. So so what I was trying to tell you is that if you buy a forward, suppose I have a payable, I buy a forward. Okay. So in that scenario, guys, what will happen that if the rate is 83 rupees per dollar, suppose, okay, and I have entered into a forward contract, in that situation, what happens that kind of, what do you say? Yeah, on the date of maturity, 31st March, suppose the rate becomes 85 rupees per dollar. Okay. I have a right to buy dollar at 83. I have a right to buy dollar at 83, correct? But the problem also is that if the rate becomes 81, I am under obligation to still buy at 83. I can't allow it to expire. So I have a right, I have an obligation also. But in options, this right and obligation gets split into two types of people. One set of people have only rights and one set of people will have only obligations. Okay. People who are having rights will have only rights, no obligation at all. Okay. And people who have obligation do not have any rights actually. So when we are talking about rights, you can have two rights, right to buy, right to sell. When you're talking about obligation, again, you can have an obligation to buy and obligation to sell also. But when I say call, buy call, why do you want to leave? Harsha, why do you want to leave options? It is so easy. It is so easy. Don't leave. Okay, so call holder. So the payoff of the call holder is given to you. The payoff of a call holder will always be 0 or positive. Okay. So I told you something, buy call, right to buy. This gives the person right to buy. So what happens now? Suppose Daniel is a person. I think that I have some stock in my mind, suppose Reliance stock, and I think that this stock will go up. I go to Daniel and say, Daniel, I will come to you and I will buy the stock at 1,000 after 3 months. He says, okay, ma'am. Okay. And he says, ma'am, please give me 100 rupees. Okay, I'll give him 100 rupees. Okay. On the day of maturity, three months at the end of the maturity, I go to Daniel and say, give me, suppose case 1, the price goes up to 1,500. Okay. But I have a right to buy the stock from Daniel at a price of 1,000. I'll go to him, give him 1,000. Okay. And he is obligated to deliver me the stock at 1,000. I will buy the stock from him at 1,000 and sell the stock in the market at 1,500. I earn 500. But I gave him something before, 100 rupees. So my net profit is 400. The question here is that case 2, the price became 900. Will I go to Daniel? Still, no, I'll not go, because I am not like commercially it is not a good decision. I will go and buy at 1,000 and sell in the market at 900. No, I wouldn't do that. My maximum loss will be 100 rupees. I am called the call holder, the call buyer. Daniel is called the call seller. I have a right to buy at 1,000. He is obligated to sell at 1,000. Remember one thing, he doesn't have the stock at this point of time. Why did he enter into such kind of transaction? Because he thought that market will not go up, ma'am will not come, and this 100 becomes mine. but opposite and contrary to his anticipation, the market went up. So he doesn't have the stock. He will buy at 1500, deliver it to me at 1000, thereby making a loss of 500. But he has taken 100 before, that is called premium actually. So he makes a loss of 400. So this is a mirror image actually. This is completely a mirror image. What is my profit is his loss. What is my income is his loss. So if one person right to buy, the other person cannot have a right to sell. The other person has to have obligation to sell. Okay. Now, buy put holder. Who is now a put holder basically? So the way I want to have a right to buy, I want to block a price to buy. Similarly, I want to block a price to sell. Why? Because I feel market will go down. I tell Daniel, I will come to you after 3 months. I will sell the stock at 1000. He says, okay, ma'am. Okay. Why did I do that? Because I blocked the price to sell and I think that market will go down. After 3 months, case 1, the market goes down at 700. And I also gave him 100 bucks. Okay. The market price became 700. My belief came out to be true. What will I do? I will buy the stock from the market at 700 and give Daniel that stock at 1000. Okay. I will give him, he will have to give me 1000 for that stock. So basically what happened? I made a profit of 300. Though I have given him 100 rupees before, 200 is my profit. Now Daniel thought that market will go up, ma'am will not come because I will not buy the stock at 1200 and deliver at 1000. That's a loss making affair. Okay, so this is how your call and put is like moving. To keep it very, very simple, call is right to buy at E. Put is right to sell at E. Don't learn profiles and diagram for all the 4. You will not be able to recall for any one of them. You can do only for 2, buy call and buy put. Remaining 2 are just opposite mirrors actually. So guys, tell me, are you able to understand this? Can I see some people responding other than Harsha? Now I've given some notes here. Quickly I'll finish. 8:30 I wind up, guys. Okay, as I had told in the okay, call will be always exercised above the strike. Okay, call will be always exercised above the strike. Just learn this. But if you learn with a logic, it will be good. Call will be exercised above the strike. Why? Because I have done a right to buy from the counterparty. Unless and until market goes up, think like this. I am not going to buy the stock from the counterparty, the call seller, and keep it to myself. No. I am going to buy from the call seller and immediately offload that stock in the market. So if the market doesn't go up, what is the point of buying the stock? Okay. Then there are 2 types of options traded in the market. European option. Okay. The options that can be exercised only on the day of maturity. Okay. And then American option. These are something very basics, guys, that you should know. Okay. And then in case of call and put, if S is greater than E, that is for call actually, is for call in the money. If it is same, at the money, and if it is less than E, out of money. If S is greater than E, out of money, same, guys. I think you can manage this one. This is very simple. I don't assume that you guys do not know this much because your exams are just standing on your door. So I assume few things. Okay, in the Hindi batch also we used to like just skip a few very basic stuff. I need to write them because they are notes. I cannot skip the notes writing part. But yeah, while teaching we can definitely do that. Some 2 very simple questions I've given to you. Consider a 2-month call option on the stock of Tata Motors at a strike price of 800, trading at a premium of 25. Be relaxed. If you understand these 4 strategies properly, you'll be able to manage any question of option for that matter. Okay, look at this. So 800. So C plus at 800, premium is 25. Okay, now here. So spot prices are given to you here. I've taken these are assumed. There is nothing given somewhere. I told you call will be always exercised above the strike. What is the strike here? 800. So till 800 the call lapses, beyond that exercised. Okay. Now payoff. Payoff will be wherever call lapses it will be 0. and wherever it is exercised, it is 825 minus 8. What do you mean by this? This means that I have a right to buy the stock at 800 and I can sell the stock at 825. Okay, so what will you earn? 25. But then 25 I have paid as premium, and hence my payoff will be 0. Okay, so 825 is my break even point. In the, I don't know whether it's a diagram or not. There's no diagram. I'll draw for you. I'll draw for the diagram for you. Look at this. Wait a minute, I did some mistake. The call diagram. So you know what, guys? Yeah. So this is your exercise price. This is your 25 negative. So till the time you exercise, this is your 800, and this is your 825. So till the time you exercise, you are incurring a loss of 25. Look at this. Can you see this? The moment you exercise, even if it is 1 rupee more than 800, you will exercise, because if you do not exercise, your premium will not reduce. Your cost of premium will remain at 25. Suppose it is 801 and you exercise, then what will happen? You will still incur a loss of 24. People can say, why are you exercising? You are still having a loss of 25, having a loss. But yeah, my loss has gone down by 1. So this is your recovery period of your premium basically. And then you have unlimited profit. Similarly, for the call writer, if you see together, it is, this column remains the same. It will be exactly opposite. How? Look at this. This was 000, it is also 000, and then this 25 were open and these are in brackets. This was in brackets, this is open, because that's your earning. Okay, and then you take out the net. So what I said, they are just mirror images actually. Guys, are you getting these things? I mean, I don't know whether I can't see anything except for 1 or 2 people. There are only 2 people watching the lecture. Look at this. Okay, so question number 14. Yeah, so I think, Harsha, we will finish this topic only, derivatives, and then we'll stop like coming live and all that, I feel. What do you say? Correct? No, because I don't see kind of no, it is not a student's mistake or something, but I feel this will be, guys, derivative will be your last topic. No, you do not need to. You do not need to. You do not need to. Not at all. Okay, so I'll complete derivatives, guys, for you completely. These are like maybe like 1 lecture or something I will take more, and then we are done. Okay, you should focus on the studies that you have to do, because exams are very nearby. Okay, consider, I have given the important questions list also for all of you. Consider a 3-month put option. Harsha, how do I do? You tell me something. You just tell me one thing. Consider 3-month put option on the stock of HUL at a strike price of, what are you asking me to do? Just imagine what you're asking me to do. Consider 3-month put option on the stock of HUL. Not that students are not wanting to attend live. I completely agree that they are wanting to, but there is no time left actually for them. They need to sit and study. Okay. And I have given you some important questions list also. You can take down that also. Consider 3-month put option, okay, on the stock of HUL at a strike price of 200, trading at a premium of 10. Show the profit profile for the put holder and the put writer. Always remember that your put will be exercised below the strike. Your put will be exercised below the strike. Look at this. Because the logic is like that way. No? What is the logic basically? The logic is that you have blocked the price to sell. but you do not have that asset. So what will you do? You will buy, you are thinking that market will go down, I will buy at a lower price and sell at a higher price, the price at which you have blocked basically. Okay, so the spot prices have been taken by me. Okay, so the lower, if you see, what is the strike price here? 200. So till 190 they exercise, because see, this is your sell price. Think like this, this is sell price. So if this is your sell price, then definitely your buy price should be lower only for a put, I'm saying. Okay, and from you cannot have a buy price of 210, you cannot have a buy price of 210, okay, with a sell price of 200. That's not, you cannot do that, right? And then you compute the payoff, okay, initial premium that you have to pay, and the net profit, guys, here, correct? No? Then put writer, exactly opposite mirror image. This usually, about the put writer, I keep on saying to the students that, guys, you should not be like calculating the put writer. It is very difficult to think. 3 you are able to call holder, call writer, okay, and put holder. These are very easy to like manage still. Okay, put writer is very difficult to manage. Why? Because if the students start learning put writer, they just forget all the remaining 3. That is how. Okay. So if you see again, this column does not change at all. Just that whatever was open in the previous part, it will be in bracket, because that's a loss for the writer. Okay, the initial will be a gain for him. Correct. So net profit will be like this only. Okay. No, Akila, I am not telling you, but in general, you guys have to be empathetic towards me also. I'm just saying that, okay, you need to be empathetic with me. See, with derivatives, your 70% portion gets over. Okay, so it is like with 4 students only, we have been able to take the batch here only. Okay, like since the start only, the number of students were very less, because I feel it is already done once in Hindi. We had huge number of students out there, and people have been, so it is the second time I'm doing the same thing, okay, on the request part, but we have not been able to see more than 4 students in the live, though recording they are watching. Okay, but for me, the what teaching in the 4th batch in the evening, and that too with 2 people, is a pain. You need to be empathetic on that part also, right? That way, nothing else. See, we did all the chapters. We did equity, we did bond, we did forex, okay, we did IFM, we did derivatives also now. So more or less it is quite a lot done for you also. Okay, I do understand it is difficult, because a 2-year-old kid will like disturb you a lot. So this is done, guys. Now, so question number 15, I think doing question would make us more interesting. Otherwise it becomes very dry for me, understand? It becomes very dry for me. If people are not, they are not, what is the point of me coming live? I mean, it is like very weird to say, you come live, I can't attend. I mean, this is very weird on your part also. Mr. X established following spread on the Delta Corporation stock, purchased 1 3-month call option. Anyways, let's continue, guys. Purchased 1 3-month call option with a premium of 30 and an exercise price of 550. Purchased 1 month put option with a premium of 5 and exercise price of 450. Okay, not a problem at all. At least we should finish this topic very properly, because derivative is a very important chapter. So what did they do? They asked questions of this kind actually. So purchased 1 3-month call option with a premium of 30 and exercise price of 550. That means C plus at 550 and a premium of 30, P plus, okay, at 450 with a price of 5. Look at this, 35, right? No. Now, if they are saying what happens if spot is 500, so if a spot is 500, what will happen? Both call and put will lapse. Why? Guys, did you understand this part? Both call and put will lapse. So at 500 guys, call will lapse because the strike is, spot is below. The strike is like the purchase price 550 is greater than 500, and at 500 even the put will lapse because put will be exercised below the strike, correct? Now look at this. So total payoff 0, initial minus 35, and we get a negative value of 3500 rupees. If S is 350, then what will happen? Call will lapse and put will be exercised naturally. Okay, so payoff from the put will be E minus. So people say that in call you have S minus E. Okay, call is S minus E, suppose. So S is here in call stands for sell price, correct? And for put, you know what? It is E minus S, where S stands for spot. So here E is your sell price and S is your buy price. So not that we are writing opposite. No, everywhere profit equation or cash flow equation will be sell price minus buy price only. That way. Now if S is 600, then put will lapse and call will be exercised. Okay, so 600 minus 550, S minus E. This is S minus E. 50, initial 35, and you take out the money. Shall I take a break of 1 minute? I just want to have some water actually. You do not have a PDF link, Harsha? Wait a minute. I'll share with you. I'll share with you. It should be there in the first lecture, na? It should be there in the first lecture. It should be there in the first lecture, yes. It should be there in the first lecture, yes. So let's start. So guys, this is hedging of foreign currencies using options. Okay, so this is one big question actually. So we can do this is why this is a very lengthy question. They have not asked many times this question, but they can ask you. Of course, they have not asked ever. It is not like that. They have definitely asked in the paper. Okay, but the frequency has been relatively on a lower side. An Indian firm has $2 lakh payable 3 months from now. The spot rate is presently rupees 43.05 per dollar. The 3-month forward rate is 43.60 per dollar. The following 3-month European options are traded. Okay. So what I want to teach you here is that, look at this. There is something that you must know, because without that you won't be able to solve the question. So suppose okay, suppose can I write here C plus, okay, buy call, right to buy at E, C minus, sell call, obligation to sell at E, then P plus, buy put, okay, then right to sell at E, and P minus is sell put, obligation to buy at E. Okay, now can you guys tell me how many ways do you see to buy? How many ways? I can see 2. I can see 2. Buy, buy. Okay, and there are 2 ways to sell also. Can you see that here and this one? So what I understand is that guys, this is for payable. Means if you have a payable, you have to buy currency and give to your counterparty, and this is for your receivable. Okay, so when to use when? 2-3 points I want to make here. Point number 1, if you remember at all in the futures hedging question, if you remember, we had 2 types of hedging questions. One was direct quote and one was indirect quote. Okay, that means suppose I'm an Indian, okay, and I have on Jan 1 I'm standing, I have to make a payment of $1 lakh at the end of the 3rd month. Okay, and I am, so what should I be scared of? I would be scared of dollar going up basically, right? I'm afraid of dollar going up basically. Okay, now what I want to say is that if you're afraid of dollar going up, you should buy dollar futures. That's what we have done. Similarly, if you are scared of dollar going up, you should buy dollar options. What are dollar options? Like this. Look at this. Like this. Correct? So these are dollar options. Whom we call dollar options? This one. This one. The denominator should be dollar only. Okay. So now here I'm saying is that if you have, suppose if it is a sum of payable, okay, and they have given you call, use call. So by default you will do C plus only. You can't do C minus. It is not, I mean, use the logic, because if you have a payable, you have to buy. So naturally you will use C plus. Okay, and if you have a, what do you say, and if you have a receivable, you will use put. So for payable it has to be C plus, and for receivable it has to be P plus. Okay, but only when this chart will only work when your quotations are direct like this. If your quotations are not direct, for example, they would have given you something like that, something maybe like dollar per rupee. If I'm in India, this quotation is an indirect quote. So if the quotation of the options was like this, okay, you won't use this chart, then this chart won't work. Again, to repeat for you, if you have, first disclaimer is that whether the quotations of the options are direct or not. If I am an Indian, then rupee per dollar quotation is a direct quote. If the quotations are direct, then for payable you will use C plus, and for receivable you will use P plus. Fine. Point number 2, if the quotations are not direct, if the quotations are like this, then what? Instead of, and if you have a payable, then you will not do C plus, you will do P plus, opposite. Why? When I am afraid of dollar going up, I buy dollar options. Okay, so I will buy dollar options. But when, so again, if I have a payable, I'm afraid of dollar going up, I need to buy dollar options. But when dollar options are not available, rather rupee options are available, then I cannot buy them. So what do? The way I am afraid of dollar going up, I am also afraid of rupee going down. So when you are afraid of something going down, you don't buy, you sell. Which strategy shows you to sell? Put. That is how you have to think. Okay. So going further here, guys, an Indian firm has $2 lakh payable 3 months from now. The spot rate is presently, it will not take much time to finish this topic now. So I will just wind up with this sum, guys. I think I'm having a lot of pain in my vocal cords because of too much of lectures, but any which ways, that is separate apart. So with this question, I think we would be only pending with valuation of options, and derivatives gets over then for you. Okay, maybe in the next lecture I think I should be able to wind up. So relax on that. Tomorrow I should be able to wind up. Tomorrow I have one less lecture, so maybe I will be able to wind up this whole thing, derivatives, whatever it is pending. Okay, it will not go beyond from tomorrow. Understood? No? Now, an Indian, let's do this question properly then. Okay, an Indian firm has $2 lakh payable 3 months from now. The spot rate is presently rupee 43.05. Today's spot rate is of no use to us any which ways, unless and until it is a money market cover. The 3-month forward rate is 43.60. Okay, the following 3-month European options are traded. Okay, so basically here, guys, what are you looking at? This 50 paisa, you can't leave it like this. Okay, you can't leave like this. So what will you do? Rupee 0.50, okay, per dollar, right? This is the quotation. This is how you have to convert. Now here, so these are the quotations given to you. Evaluate no cover, forward cover, okay, call cover, put cover, and range forward. So no cover means you are not taking any hedging thing. Okay, you will keep your positions open. What will you do? You will multiply these rates with the probabilities and take out a rate, and multiply it means, I mean, on zero, how do I know what will be the rate on maturity? So you do this, guys, you get the rate, and you multiply, you get the pay. Means if you do not take any cover, it is expected that you will be making a payment of this amount on the day of maturity. Then forward cover, forward rate is given to you, and then you calculate. My only question to you is that when I'm doing all these calculations, where am I standing? I'm standing on day 0 or maturity. I am standing on 0 only naturally. Okay. No, Akila, no. On maturity, you don't have a choice. You have only no cover. On maturity, you do not have day 0. Yeah, on maturity, you cannot do anything. You cannot book a forward. You have to stand at 0 to contemplate all these choices. Okay. Now call cover. So are the quotations direct? Yes. And what do I have? I have a payable. So can I take C plus? Yes, I can take C plus. Look at this. So C plus at E 43.50. Premium is this. So on $2 lakh, you will pay a premium of 80,000. Now look at this. I'll have to like contemplate the way we do. 41.5. These are the expected spot rates on the day of maturity. So I told you, call will be exercised above the maturity. Okay. So above the maturity, 44.5 exercise. Look at this, they have been exercised. Payoff 0, 0. And then this is positive payoff 1 and 2.5. Now, two things are going on together. If I was a speculator, this column wouldn't have come only because I have just taken my money and gone. But I am a hedger. I need currency. So basically, I am squaring off my position in options in the derivative market. And this, if the rate in the market is 41.5, I will buy at 41.5. If the rate is 43, I'll buy at 43. If the rate is 44.5, I'll use 44.5 and so on. Okay. Now combine this to get a net rate. So net rate is what? 41.5. Now the beauty of the option is that when the market went down, it allowed you to use this rates. If it was a forward, no. You are supposed to close your square of your position at that rate only. And then when the market goes up, look at this, when the market goes up, your net cost remains at exercise price only. And then multiply with the purchase cost and premium and everything, take out the answer. Similarly, guys, this is, and multiply with the probabilities because we do not know which price will happen. So expected value is this. If you buy a call cover, then this is the amount of outflow on the day of the maturity. Then you have put cover. So in put cover, you have obligation to sell. Okay. So this will be a bit complicated. I will request you to sit at home and try to just kind of understand what exactly is going. Then ask me doubts if you have. Again, the same columns. Put will be exercised below the maturity. So below the strike. So 42.5, the lower price 41. Rest are zeros. But since it is a P minus, always remember C plus will have a payoff positive. Plus will have a positive payoff, negative will have a negative payoff. So the payoff will be negative. And these are the cost of my buy. Okay, I add both of them. And my value, these are the rates. Again, multiply with the values and compute the values. Range forward, I need to make you understand this one. Range forward. In range forward, what happens? Suppose ideally, I would want to buy a call. But there is a payment of 80,000 there. So when you buy call, you have to pay the premium component. Okay. And when you write a put, when you are doing a P minus, you receive 1 lakh. Okay. So when I do a range forward, I do it in order to reduce my premium component. So I pay 80,000, receive 1 lakh. So the net cost is still plus 20,000. Okay. But there is a trade-off. What trade-off? Now your cost cannot go below 42.5. So the range will be 43.5 to 42.5. So you have to just combine both of them if you see here, okay, and take out the rate. So the best will be range forward. So look at this. You can take the call at 41.5, call will lapse, and then you have exercise. And for put you have, like you already had, one negative, lapse, then rate, and then combine this and this together to get this column. Okay, you get this column, multiply with the amount, and you have gotten the answer. Lowest will be your answer. Guys, I have a lot of pain here. I'm just winding up here, and anyways we could cover good amount actually. So we are already on the 20th page, almost, like if you see, we are on the 20th page only. So I think hardly 8 pages are there. Tomorrow I will finish your derivatives and you will be done with the derivatives actually. Okay, so bye everybody. Just go and study whatever you have. I have given you the important questions. Now you can start doing, at least do the important question list of equity is big. Bond I have not given for my students at least, and but the list is there. Okay, You can do forex, you can do IFM, you can do derivatives also now to a certain extent. So start studying, please. I'm winding up here. I need to take care of my throat, I feel. So tomorrow again I'm coming at the same time, 7 o'clock. We can finish this topic. Only topic that I think is left out will be valuation. Look at this, valuation of options, and one question with the indirect quote, this one, and then it would be done with the derivatives. Okay, chalo, bye bye everybody.